This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Record finish, stocks swing to new highs, but it wasn't because of a rally in bank stocks, even though some of the biggest ones easily beat earnings expectations.
Reinventing America, how the economies of mid-sized cities across the country are being transformed by the rise of online shopping.
And the world is your lobster, especially in Maine, where business is really booming. Those stories and more tonight on Nightly Business Report for Friday, July 14th.
Good evening, everybody, and welcome. The Dow closed at its 25th record of the year. The S&P 500 is also at a new high. We'll have more on that in just a moment. But we begin tonight with the big quarter for some of the biggest banks. JP Morgan, Citigroup, Wells Fargo, and PNC Financial all reported better than expected earnings. That's the good news. But there's more to it. And it's important to understand what's happening in that sector, which plays a vital role in the economy, fueling activity for both households and businesses. Today, those better than expected earnings results were not enough to lift the stocks, and they all finished lower. Bob Pisani explains why.
All four banks reporting today, JP Morgan, Citigroup, Wells Fargo, and PNC, beat earnings expectations. So why did they all trade down today? Well, there were several issues. First, trading activity in both stocks and bonds was below expectations. You can blame that on the low volatility we've seen for some time now. Trading is a major source of revenue, often dwarfing fees from other bank businesses. Second, the economic data was disappointing. Consumer prices were weak, which means inflation is still below the Fed's target. That caused interest rates to move down, and lower interest rates means that banks will make less profit from interest income, which is the difference between interest earned on things like loans and interest paid on things like deposits. Expect analysts to modestly lower earnings expectations for the banks in the second half of the year. Finally, there's a seasonal phenomenon. Bank stocks tend to move higher in the month before JP Morgan reports earnings and move slightly down on the day of the report and generally flat the whole month after, even as the rest of the market moves up. It's a fairly typical phenomenon for Wall Street. Investors will typically buy on the rumor and sell on the news. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
On Wall Street, stocks rose to those records on upbeat expectations for earnings season, and the S&P 500 recorded its best weekly performance since late May. The Dow Jones Industrial Average advanced 84 points to an all-time closing high of 21,637. NASDAQ was up 38, and the S&P 500 added 11, also a record. For the week, all of the major indexes gained at least 1%. You're richer at the end of the week than you were on Monday. And the biggest gainer on the Dow Index today was Walmart. The company got a vote of confidence from Goldman Sachs, which said the discount retailer was well equipped to hold its own against the growing clout of Amazon.
So how does Walmart stack up against Amazon? We dug up some numbers and put them side by side. Walmart, founded in 1962, has more than 11,000 stores in 28 countries and more than 2 million employees. It's still the world's biggest company by sales, more than $485 billion worth last year, but the 5-year sales trend is relatively flat. Net income is more than $13 billion, but that number's been shrinking. It was $17 billion in 2013. Walmart's total market cap, or the value of its outstanding shares, is more than $226 billion. Amazon, the online specialist founded in 1994, just made a huge splash, announcing its intention to buy Whole Foods. Its most recent annual sales, more than $135 billion and growing, up more than 20% a year since 2012. Net income rose more than 300% last year to more than $2.33 billion. With its stock price just above $1,000 a share, Amazon's market cap at more than $478 billion dwarfs Walmart's.
So, which retail giant will have the competitive edge with consumers in the long run? Here to discuss that is Tom Blishock. He's the chairman and CEO of retail consulting firm Dialogic Group. Tom, welcome. Good to have you with us. Welcome back, I should say, with us earlier this week. So, is there room for these two to coexist?
Oh, absolutely, Tyler. Walmart's going to have 140 million people visit the stores this week, and Amazon has about 66 million subscribers for Amazon Prime. Absolutely. Both of these folks are offering price and convenience. Amazon will offer convenience first, price second. Walmart offers convenience first and price second. It's a marvelous time to be in retailing.
Well, there are some who would disagree with that, saying that there isn't room for both of them because Amazon seems to be kind of eating everything up. But the cultures of those two companies seem very different to me, and maybe that's how they coexist.
Well, they coexist by the fact that some shoppers are going to buy online and some shoppers want to go to stores. We're not going to see the demise of stores the way many people predict. I think there is a strong probability that both of these giants are going to not only survive, but prosper in their respective markets. Remember, Walmart is to America bricks and mortar unparalleled. Amazon is to America online unparalleled.
So talk to me about how the two companies are moving. Walmart, obviously by its investments in recent years, has put a bigger emphasis on its online omni-channel approach. At the same time, Amazon goes out and buys Whole Foods, which is a brick and mortar store. They're opening their own brick and mortar bookstores in some neighborhoods. Talk me through that. Where does that lead?
So let's start with Walmart first. Walmart is a retailer who's moving to digital technologies, and with their acquisition of Jet.com, really is in the sweet spot of how to play digitally. Amazon is a digital technology company who is moving into bricks and mortar, recognizing that digital equals physical. Both of these organizations are attempting to understand how to balance their approach to addressing the changing customer needs. Do I want to have something delivered to my home? Do I want to go to the store? Both of them have a tremendous opportunity to grow in this market space.
Who do you think strategically has a better plan longer term? Or do they both have a good plan?
Sue, they both have a great plan. In the past couple of years, Walmart has done a bang-up job on changing the in-store experience. Amazon has done a bang-up job on something called anticipatory forecasting, anticipating what should be in the market for the consumer. Both of these folks are playing retailing from a different part of the end zone and doing it very, very effectively.
Very quickly, do you worry, as Sue pointed out in the little setup piece, that Walmart's profits are actually declining, Amazon's are growing, which is probably why it has the bigger stock market value?
Well, let's talk about prices declining. You know, we've been in 6 months of food deflation in 2017.
I'm talking about profits declining, not prices, profits for Walmart.
No, I understand. So Walmart continues to make investments in various assets in the business. So does Amazon. Remember, in Amazon, when we look at what Amazon's selling, it's not only groceries. It would be fair to compare the grocery profits of Amazon to the grocery profits of Walmart. That would be a little bit better balanced from my perspective, from a profit perspective.
Have to leave it there. Tom Blishock, we appreciate you coming with us twice in a week. Dialogic Group.
My pleasure. See you guys. Bye.
A Democratic U.S. congressman is calling for a hearing on Amazon's plan to acquire Whole Foods. Representative David Cicilline of Rhode Island wants to look into the deal's potential impact on customers. In a letter to the chair of the House Judiciary Committee, he said the proposed purchase could impact neighborhood grocery stores. That deal must first be approved by U.S. antitrust regulators.
Retail sales fell for a second straight month. Consumers spent less at restaurants, department stores, despite that healthy job market. Commerce Department reports a decline of 0.2% in June, expectations for a slight increase. That report also shows that sales at non-store retailers from places like Amazon and other online stores were up from last year.
The fast growth in online shopping has led to the construction of big warehouses or fulfillment centers that help retailers deliver those items that you ordered quickly. And all that building is transforming towns and cities across America. Aditi Roy is in Tracy, California.
Downtown Tracy, California is busy, bustling, and full of businesses. Its mayor says these shops and restaurants are benefiting from what's happening on the outskirts of town. The industrial sector of Tracy is booming with fulfillment centers from e-commerce companies like Amazon and Crate & Barrel.
The fulfillment centers and distribution centers can ship their goods pretty much anywhere from here in a very short amount of time.
Drive through this part of town and you'll see the massive modern-day warehouses dotting the streets, FedEx and Safeway are among them. Tracy, about 70 miles from San Francisco, is just one of the country's hotspots for fulfillment businesses. Other top regions include central New Jersey, Lehigh Valley, Pennsylvania, and Louisville, Kentucky, mid-sized cities that are right on the periphery of major metropolitan areas, where land and operating costs are cheaper and labor is ample. Here in Tracy, one expert estimates fulfillment centers have brought up to 10,000 new jobs to the county in the last 5 years. It's also diversified the economy of a town once known as a railroad hub, the local headquarters for Southern Pacific. Then food manufacturers like Heinz and Holly Sugar moved into Tracy, also known for agriculture.
Now those businesses have moved on or closed. Different type of businesses have come, and then you start seeing the distribution because of our location.
The burst of new business has prompted the city to create this drone video showing the city's available commercial land to entice even more companies here. And while some critics argue that fulfillment center jobs, which typically average between $13 to $16 an hour, according to one expert, may not provide enough to raise a family, Tracy's mayor says they still add economic value.
The people that come to our jobs here in Tracy are not just also from Tracy, but throughout the region. And what that also does is, it brings the people in Tracy, it increases our daytime population, which in turn helps us attract more businesses like restaurants and retail and commercial.
He also tells me that in the last quarter alone, the city's sales tax revenues went up 35%, which is helping build more city parks and improve infrastructure. For Nightly Business Report, I'm Aditi Roy, Tracy, California.
Still ahead, want to be a landlord? A new company will tell you whether it's worth the risk.
First-time homebuyers are showing more interest in making a purchase. According to the Wall Street Journal, Google searches related to buying a first home are up double digits this year when compared to a year earlier. And the National Association of Realtors says first-time buyers accounted for more than 30% of all home sales in May, despite rising prices and concerns over affordability.
Seems like everyone you talk to today is toying with the idea of being a landlord, and why not? Demand for rental homes is high, but so is the risk. Now, one company is trying to change that. Diana Olick has our story.
Becoming a landlord today looks like a no-brainer. There are lots of companies to help you buy, manage, and even renovate rental homes. And with home prices sky high, demand for rental homes is stronger than ever. But not every property will offer great returns, and some could offer great risk, especially if small investors continue to do it the old-fashioned way. That is, invest in their own backyards.
About 70% of the rental homes are owned within an hour drive of where the investor lives, which is a horrible diversification strategy if you think about it.
So Roofstock, an online marketplace for single-family rental homes, is launching a new rental index. It rates every neighborhood in the nation for risk. 72,000 separate census tracts with about 1,500 homes per tract.
What we've done is taken all that data and broken it down into really little pieces and analyzed a lot of things that influence the characteristics of that neighborhood. And these are things like income levels, percentage of home ownership, bachelor degrees, employment, things like that.
Competitors in the rental marketplace like 10X, Home Union, and Investability all offer data on investor returns for local markets, but they don't get as granular with the risk. Roofstock's idea is to open up the nation's neighborhoods to all investors everywhere and give them a peek inside, especially as more and more novices enter the market.
It's a new landlord nation where everybody is renting out their basement. When somebody moves up, they don't sell their old place, they rent it out to somebody else.
Whether it's your own house or one in a neighborhood 9 states away, as an investor, weighing the risk is just as important as calculating the reward. And as with everything else today, data and technology are the keys to cash. For Nightly Business Report, I'm Diana Olick in Washington.
To read more about assessing your risk in becoming a landlord, head to our website, NBR.com.
Sprint may be looking for investments from two corporate heavyweights. That's where we begin tonight's market focus. The Wall Street Journal says the telecom company met with billionaire investor Warren Buffett and separately with media business giant John Malone regarding a potential deal. The details are unknown, but the report noted that Buffett could put more than $10 billion into a transaction. Bloomberg also reported Buffett is considering investing as much as $20 billion in Sprint. Sprint shares jumped 4% to $8.55. The health insurer Anthem is suing Insys Therapeutics, alleging the drug maker lied to Anthem about patients' diagnosis so that it could receive reimbursements for its powerful opioid pain medicine Subsys. Anthem says the fraudulent scheme cost it more than $19 million in reimbursement payouts. Insys has been under ongoing investigations for its sales and marketing practices of Subsys. Anthem shares were up a penny to $192.56, while shares of Insys fell 5% to $12.15.
AstraZeneca has remained tight-lipped on a report that said the drug maker's CEO is planning to stay in his role at the company for the foreseeable future. This news contrasts with earlier reports that the chief executive was in talks to join the rival drug maker Teva Pharmaceuticals. AstraZeneca shares rose more than 4% on the news to $33.87. Shares of Teva Pharmaceuticals down roughly 4% at $31.90. And shares of the data network company A10 Networks fell after the company shook investors last night with its preliminary results. A10 said weaker performance in its North America and Japan markets would cause sales this quarter to come in nearly $10 million lighter than expected. The company said profit will also come up short, and shares of A10 did today, plunging 16% to $6.92.
It is time for our market monitor, who has names of three companies he says tend to raise dividends at a higher rate than the market rate. Last time he was on in September, he recommended American Tower, which is up 20%, Lowe's higher by 6%, and CVS, which is down by 13%. Joining us is Mark Spellman, portfolio manager at Alpine Funds. Mark, welcome back. Nice to have you here.
Thank you very much.
Let's get to your picks, because one of them is still on the list, and that is Lowe's. You've been adding to positions here.
Yeah, Lowe's has started out the year doing very well, I think somewhat at the expense of Sears when it comes to appliance sales. But in the last month or so, they've been caught up in the Amazon is taking over the world worries that are going on Wall Street. We actually think Lowe's is going to be able to compete quite well with Amazon going forward. This company we think is going to grow earnings by 15% moving forward. The dividend is 2.1%. They just last month raised it 17%. That's a name we like in our rising dividend fund right here.
Let's take a look at Cisco, which is your second pick. I am impressed by a 3.7% yield on that stock. I am less impressed by its historical returns over the past decade.
Yes, it's a company in transition for sure. It was the ruler of the networking world, and it's having a little harder time transitioning to the data-driven cloud world. We think they're on the cusp of doing that. You may have to wait a little while, but that 3.7% dividend yield you just mentioned is a pretty comfortable thing to sleep at night while you're waiting. Now, mind you, in the last 14 months, that dividend is up 38%. That's an amazing statistic if you think about it. We like the stock. We think it's just too cheap right here.
And speaking of dividends, the 5.4% yield on AT&T has made it quite attractive to you.
Yeah, again, too cheap to ignore. The dividend is just too big to ignore. We think there's a couple of things going on there. People are worried about the wireless business. We personally think there might be a lag before the iPhone 8 hits this fall. That may be why the stock has been underperforming. It's down about 15% this year. Then you add the Time Warner Communication deal that's supposed to close at the end of this year. We think that's going to be very good for the name, very good for the stock. We like the stock.
Let's talk about one of your picks that is from the last time, which was CVS Health, down this time. What do I do with it if I bought it?
Yeah, we think you step aside. Now, that's a name we purchased. It was last year in September. It was prior to the Trump administration. They've really made a focus on drug pricing. And obviously, 60% of what CVS does is pharmacy benefit management. It's really up in the air how that's going to fall out. All we know is the rhetoric is certainly heavy against any kind of drug pricing, pushing companies to lower prices. We're really not sure what's going to happen, and that makes us pause and step aside.
Very quickly, generally speaking, do you like the market at these levels? I mean, we're hitting records on a fairly frequent basis.
Yeah, I think the big news this week is Janet Yellen saying we've raised rates 3 times, and now we're going to take a pause. Some of the economic data is a little bit soft, but some of the economic data is very good. Housing, home improvement, employment, they're all very good. We're optimistic on earnings going forward. With historically very low, even though we've raised rates 3 times in this short period of time, historically very low rates when you think about it on the 10-year 2.2, we think we're still optimistic. We think you're in a pretty good sweet spot here, green light.
All right, on that note, thanks so much, Mark. Mark
Thank
Spellman
you.
with Alpine Funds. Coming up, the big catch.
Lobstermen are experiencing record harvests. I'm Contessa Brewer off the coast of Maine. We'll tell you how they're opening new markets and creating new demand to keep prices steady.
The latest report card on airline service in America shows passengers arriving a little later, complaining a little more. Still, the industry is enjoying a rebound thanks to strong demand. Phil LeBeau takes a look at the state of the airlines in the U.S.
With the number of flights in the U.S. close to a record high, it's not surprising to see fewer flights arriving on time. While almost 4 out of every 5 flights were on time in May, some airlines did much better than that. As is often the case, Hawaiian Airlines had the highest on-time arrival rate in the industry, just ahead of Delta, Alaska, SkyWest, and United. By comparison, other airlines, including Spirit, JetBlue, and Virgin America, struggled in May. But the real story for passengers this spring was the scrutiny airlines were facing for high-profile altercations. That includes a family being bumped from a Delta flight and releasing a video of their confrontation with the flight crew. That story in early May dominated the headlines, which could explain why passenger complaints in May jumped 56% compared to the same time in 2016. It was the second straight month where the DOT saw a surge in airline complaints. But whatever issues Americans have with flying, it's not stopping them from getting on board. In fact, demand remains strong. Which explains why the airlines are expected to report solid profits for the second quarter. Next up, United Airlines, which will be reporting its second quarter earnings next week. Phil LeBeau, Nightly Business Report, Chicago.
Are you traveling to Maine? Well, if the answer is yes, you'll probably dine on some lobster, which is seeing record demand, and not just in the U.S. International consumers have developed a taste for it as well. And that means big business for lobstermen on the coast of Maine. Contessa Brewer has our story.
Jack Thomas has been lobstering since he was 14 years old. And though he has a day job as a financial advisor, in the mornings he's out checking his traps. These days, he's really hauling them in.
The last couple of years have been record years for me.
U.S. lobstermen have quintupled their catch over the last 30 years, last year bringing in a record 131 million lobster. More than 80% of that came from Maine. In 2012, a historic harvest sent prices plummeting. The industry responded with a big push into new foreign markets.
China saved our bacon. The price was at an all-time low. I think the statewide average was $2.69. And we aggressively opened a market over there, and it became very popular within the middle class.
And demand in China keeps growing, from 1.3 million lobster in 2010 to more than 84 million last year. A pound-and-a-half lobster will fetch as much as $100 at a Chinese celebration. It's popular because its name means dragon, it resembles the mythical creature, and when cooked, turns the lucky color red. Distributors are also marketing Maine lobster to families as a clean source of quality protein.
If we want to continue to develop those markets, we have to provide a premium product. And that means that a lobster that arrives whole, that has been kept temperature and has been hydrated and doesn't spend too long out of the water.
Distributors are conquering the logistical challenges, controlling transit times, temperatures, and the delicate handling essential to live lobster. And now the industry's moving more processed and frozen lobster.
There was a lot of investment in processing. What a processor does is take a live lobster and extend the shelf life of it.
And now the industry's teaching chefs how to use that product in innovative dishes.
And it's not just about finding new international customers for the lobster. The industry is also trying to build more demand in the United States.
People care about who catches their food. Well, our lobstermen are some of the best people on the planet. And so telling their stories matters a lot.
So lobstermen fly to events around the country to meet chefs face to face, talking about sustainability. That commitment began more than a century ago, with lobstermen throwing back undersized or oversized lobster and leaving the egg-bearing females. Lobster flourished as other industries overfished predator species like haddock.
The whole industry started by, fathers, sons, daughters getting into the business and teaching, here, this is how you do it. This is the proper way. Take care of it so you can have it for tomorrow.
Lobstermen are hoping that by finding new markets and new customers, it means that this will be an industry that thrives for generations to come. For Nightly Business Report, I'm Contessa Brewer off the coast of Maine.
Makes you hungry.
Contessa's a hands-on reporter there.
She certainly is, and Maine
right.
is so beautiful.
Yeah,
it's one of my favorite states. Well, that'll do it for us tonight. I'm Sue Herrera. Thanks for joining us.
I'm Tyler Matheson. Thanks from me as well. Have a great weekend, everybody, and we'll see you right back here on Monday evening.